Take a step back for a moment and look at what the energy market is actually signaling right now. On the surface, the headlines say oil is simply rising because of tensions around Iran. But when you connect the numbers, the story becomes much larger. Nearly 20 million barrels of oil per day, roughly 1/5 of global supply flowing through the Strait of Hormuz, is now sitting under the shadow of disruption. And when the largest emergency release on record cannot push oil lower, the message from the market becomes difficult to ignore, a pace rarely seen in modern energy markets. And when a move accelerates this quickly, traders stop asking whether the market is tightening. They start asking how large the shock could become. Officials from institutions like the International Energy Agency have already warned that the scale of the disruption could be one of the largest in modern history. Meanwhile, analysts across Wall Street are beginning to model scenarios where oil climbs far beyond current levels if the strait closes. In other words, this is no longer just a geopolitical headline. It is the early signal of a potential global energy shock, the kind that quietly begins in commodities before forcing the entire financial system to reprice risk. And once markets begin that process, the implications rarely stop with oil alone. But the real story here is not just the price of oil. The deeper story is how the financial system begins to react once energy shocks enter the picture. Historically, the sequence is almost mechanical. Oil moves first, inflation expectations follow. Central banks hesitate, bond yields adjust, and suddenly the stability investors assumed was permanent begins to look fragile. We are already seeing early hints of that process. As crude prices surge, the US dollar has strengthened. Treasury yields have pushed higher, and equity markets, from the Dow Jones to the Nasdaq, have started to wobble under the weight of rising uncertainty. Institutions like the Federal Reserve now face a far more complicated landscape. Inflation measured through indicators such as the PCE index, which rose 0.3% in January, remains persistent. At the same moment, geopolitical risk is pushing energy costs higher. That combination forces markets to reconsider a simple narrative many investors had become comfortable with: the idea that interest rates would soon fall again. Instead, traders are beginning to price in a world where monetary policy may remain tight longer than expected. And when energy, inflation, and interest rates begin moving together like this, the story stops being about a single commodity. It becomes a signal about how the entire economic system is adjusting beneath the surface. And this is where the metals market quietly enters the story. Many people assume that when geopolitical tensions rise, gold and silver should immediately surge. But markets rarely move in such a simple, linear way. In the early phase of a shock like this, the opposite can sometimes happen. As oil prices climb and uncertainty spreads through energy markets, the US dollar tends to strengthen and treasury yields rise. That dynamic tightens financial conditions across the system. We have already seen hints of this shift as investors reposition around the Federal Reserve's policy outlook. Persistent inflation readings, such as the 0.3% monthly increase in the PCE index, are forcing traders to reconsider how quickly interest rates can fall. In that environment, metals can appear strangely quiet, even as the forces that ultimately support them begin building beneath the surface. Historically, this is how many commodity cycles begin. Energy shocks move first, financial conditions tighten. And only later do precious metals begin reflecting the deeper shift taking place inside the system. In other words, gold and silver are rarely the first signal of change. They are often the confirmation that something larger is already unfolding. And if the current energy disruption continues to spread through inflation, policy expectations, and global liquidity, the metals market may soon start responding in ways that reshape how investors interpret risk itself. But if you want to understand where this story may ultimately lead, history offers a surprisingly clear guide. When major geopolitical shocks hit the energy market, oil almost always moves first, and what follows rarely remains confined to the energy sector. Look back at 1973 during the Yom Kippur War. Supply disruption sent oil prices surging, and the global economy entered a prolonged period of inflation and instability. Or consider 1979 and the Iranian Revolution. Another sharp oil shock helped trigger one of the most powerful rallies in gold in modern financial history. The pattern tends to repeat: because energy sits at the foundation of the entire economic system. When oil rises sharply, transportation costs climb, manufacturing expenses increase, and food prices eventually follow. Inflation begins to seep into places where policymakers struggle to contain it. Institutions such as the Federal Reserve, the European Central Bank, and other major central banks then face a difficult dilemma: fight inflation with higher interest rates, or risk allowing price pressures to spread further. And as that tension builds, financial markets, from bonds to equities to currencies, must gradually reprice a world that suddenly looks less stable than it did before the shock began. Which raises a deeper question now quietly forming across global markets. And this is where the conversation becomes larger than oil itself. Because when markets begin asking whether energy prices could climb toward $150 or even $200 per barrel, the real question is not the number on the screen today. The deeper question is whether the global economy is quietly entering the early stages of a new commodity cycle. When you step back and connect the signals, several powerful forces are beginning to align at the same time. Geopolitical tensions across the Middle East, the renewed focus on energy security, the massive electricity demand being driven by AI infrastructure and electrification, and years of underinvestment in energy production. All of these forces have been building pressure beneath the surface of the system. Analysts like Lars Hansen from the Gold and Silver Club have pointed out that markets often underestimate the scale of these structural shifts, until prices themselves force investors to reconsider, and history shows that when commodities begin repricing under those conditions, the adjustment rarely happens quietly. Energy markets move first, then capital flows begin shifting across the broader resource sector, from industrial metals to precious metals. Meanwhile, institutions from Deutsche Bank to JP Morgan start recalibrating their long-term projections. In other words, what we may be witnessing right now is not simply volatility in oil markets, but the early formation of a much larger economic narrative that investors are only beginning to recognize. And this is precisely why markets are becoming so sensitive right now. When oil prices surge while inflation remains stubborn and growth begins to slow, the system enters a far more uncomfortable phase. We are already seeing the early outlines of that environment. Brent crude has pushed beyond $100 per barrel. WTI recently traded near $98.71. At the same time, equity markets from the Dow Jones to the Nasdaq have shown signs of instability. Inflation pressures have not disappeared. The US PCE index rose 0.3% in January. That reading reminded investors that price pressures remain embedded in the system. That combination is forcing a subtle but important shift in expectations. Only weeks ago, traders were pricing in multiple interest rate cuts from the Federal Reserve this year. Now markets are beginning to accept a far more complicated reality. Policy may remain restrictive for longer. When oil, inflation, and monetary policy begin interacting this way, economists often use a word that carries heavy historical weight: stagflation. It describes an environment where growth slows while prices remain elevated, leaving policymakers with fewer tools to stabilize the system. And historically, periods like this have tended to reshape how investors think about risk, liquidity, and the role of assets like gold and silver within the global financial structure. And this is why many analysts are beginning to argue that what we are witnessing may only be the first phase of the story, not the conclusion. Right now, the picture looks almost contradictory. Oil prices are climbing rapidly, with Brent trading above $103 per barrel. WTI is near 98 cents. At the same time, precious metals like gold have recently slipped toward $5,014 per ounce, even as geopolitical tensions intensify across the Middle East. But markets rarely move in straight lines during the early stages of a structural shift. In fact, the current environment often reflects the system trying to absorb a shock rather than resolve it. The US dollar strengthens, treasury yields rise, and equity markets from the S&P 500 to the STOXX 600 show volatility. When energy costs begin pushing inflation expectations higher, central banks may find themselves constrained. Institutions such as the Federal Reserve, the European Central Bank, and the Bank of England may be unable to ease policy as quickly as investors once hoped. And once that realization spreads through the financial system, the conversation begins to change. What initially looked like a temporary geopolitical disturbance starts to resemble the early stage of a broader repricing of risk across commodities, currencies, and capital markets, which raises an even larger question that investors around the world are now quietly beginning to consider. So, when you step back and connect all of these signals together, the real question facing markets is no longer just about where oil trades tomorrow. The deeper question is whether the global economy is quietly moving into the early stages of a much larger energy shock. Right now, we see the ingredients assembling in real time. Brent crude has pushed above $103 per barrel. WTI trades near $98. Tensions around the Strait of Hormuz continue to threaten a route responsible for nearly 20% of global oil supply. Policymakers from the Federal Reserve to the European Central Bank are already navigating an environment where inflation pressures refuse to fade. When energy, geopolitics, and monetary policy begin colliding like this, markets rarely respond in a calm or orderly way. Instead, the system begins slowly repricing everything, from interest rate expectations to currency strength and global capital flows. History has shown that these transitions often begin quietly, hidden beneath what appear to be isolated commodity moves, before expanding into much broader economic shifts. And that is why the current moment may matter more than the daily volatility on any single chart. When energy, geopolitics, and monetary policy begin colliding like this, markets rarely respond in a calm or orderly way.